The American consumer is the most pessimistic they've ever been.
One study shows a nearly 40% decline from a year ago.
Americans' outlook for the economy has grown just a bit more pessimistic in the past month.
They're continuing to spend. Last year we saw this with tariffs. We saw a huge dive at this point last year in consumer sentiment. Consumers got really pessimistic. The data suggests that they didn't spend any less.
On today's State of Durables, I'm joined with Ralph McLaughlin, the chief economist from OpenBrand. There's a lot of turbulence going on right now in the world, and we're going to talk about that turbulence, what it might mean for you, what it might mean for the rest of the durables market today.
Look forward to talking to you about the macroeconomic environment, about prospects for inflation, about geopolitical conflicts, how the war in Iran will play out, and probably most importantly for all of our listeners is what does it mean for supply and demand of durable goods.
Yeah, and you mentioned inflation. So, I think as a quick preview, we've seen so far a little bit of an uptick in prices over the last month or so. We've also seen an uptick in discounting. We had a big promotional period at the end of March. So hopefully you can dive in and help our audience understand, the dynamics at play there as well.
Yeah, we got things moving on both sides of the equation. And so sorting through what that actually means net does require more of a deeper dive. So look forward to chatting about that.
That's great.
Yeah, let's start at 30,000 foot view about what's going on in the economy. To sum it up, we've got mixed signals, and usually the signals are not always in one direction or the other anytime you're looking at the macro economy. But I think the start to 2026 emphasizes that. Headed into the early months of 2026, January, February, there were some signs that were causing folks to be pretty apprehensive about the economy. Some of those signs, we have updated information that leads us to believe maybe they weren't as bad as they could be. So first sign, elephant in the room, is going to be talking about GDP, what's gone on with GDP. We saw a pretty significant slowdown in GDP at the end of 2025, which is the most recent number. GDP slowed to just about 0.5% on a year-over-year basis. We had been averaging, up into the 2s and 3s over the last several years. So what's happening? Well, what do we know about the end of last year?
Shut down.
The government shut down. And, it turns out there are a non-trivial number of people that are employed by the government, and there's businesses that depend on the government.
Yeah.
Just a matter of millions. Yeah. So government shut down. We expect that to be transitory, not expected. We do expect it to be transitory. We expect that to rebound in Q1 and a little bit into Q2. One of the reasons why we think it's going to rebound, number one, the government opened again, right? For the most part, it's opened. And second is we do have the impacts of the One Big Beautiful Bill Act acting as a stimulus that is coming out right about now. Today's Monday, April 13th.
A lot of people are expecting checks.
Yeah,
in the mail
I don't know about you.
For the first time,
Have you done your taxes yet? You filed your taxes yet?
I still have a few more days.
Just a few more days.
2 more days.
Or extension.
Yeah.
I'm super proud of myself. It's the first year I think I've filed without an extension in about 4 years. So I'm super proud of that. And other people are frowning. So, we're expecting the impact of that, effectively a stimulus, to be kicking in right now. So that's all happening while not only do we have the outfall of the government shutdown, but also, the conflict that we're having in the Middle East. But
right. And what better way to spend your $4,000 or $5,000 or $3,000 refund from the government than on a new refrigerator or oven?
Yeah. And if you lived out in the West, we had a crazy heat wave, and maybe people realized that their air conditioning, they were kicking on. I was using my air conditioning in March, and I'm like, shoot, maybe I think
mine's on now.
Yours is, New York. Yeah. You guys got the heat wave too. So there were some mixed signals on that front. One of the other signals that people were a little pessimistic about earlier in the year was job numbers. So, we really had pretty anemic job growth numbers in January and February. And on top of that, we had a bunch of revisions last year that basically put net job growth last year, kind of close to zero. Or basically, it was in the range of the amount you would expect in 1 month. We had the entire year. So folks were getting pretty pessimistic about that. But March
that was a pattern we saw in parts of 2024, I think, too.
We were getting revisions, yes, well beyond. And some of that has to do with things technical things related to how we measure job growth. But there is some interesting research that has come out recently that does suggest that a break-even point for job growth now is basically zero, and that's driven primarily by the fact that the labor force is shrinking. The number of people that are actually engaging in work or looking to engage in work is turning negative.
Well, right. I mean, like the baby boomers are either the first or
Yeah.
second largest cohort, right?
Yeah,
So,
like my dad's no interest in working
Yeah.
at all. We did see times where like COVID pulled some of those people back in, but that's pretty much gone away. So point being, what came out of the Fed, the research that came out of the Fed was suggesting that because the break-even point of job growth of people, neither, unemployment rate either going up or neither going up or going down, the break-even point is essentially zero job growth. Now, that doesn't happen every month. You get employers that start to hire a bunch, and then you get other employers that maybe lay people off. But the point being is that it could be the actual break-even number of job growths could be up 1 month and down 1 month, and net, it's going to be probably around zero. March, we saw a huge gain in jobs. We saw 178,000 jobs, one of the best reports we've had in a couple of years. So anyways, I mentioned that because just because we get job growth that is, maybe around zero or sometimes negative, sometimes positive, the Fed research is suggesting that might be the new normal.
right. Just a classic example of, the current is not going to equal the past. The future is not going to equal the past. And by the way, that just might be okay.
Yeah, we just have to temper our expectations. Just because we get a job growth number that is, 5,000 a month or 10,000 a month.
Right.
Remember a few years ago we would, kind of scoff at anything that was under 100,000, and that's just it's a new normal that we have to be used to it. And without that research, when that starts to proliferate into folks that trade or folks that make hiring decisions or basically using signs of the economy, we have to get used to that. And so we may not get as much of a reaction to numbers that historically speaking would have been pretty dismal.
Right.
Now may not be so dismal.
Right. And we're also seeing a huge increase in productivity recently. So that's sort of a nice offset to maybe people not wanting to work as much.
That's a very important point. That essentially one of the major sources of growth going forward may not necessarily be totally on hiring people. It may be on productivity and investment in things like data centers or investment in technology. So that's kind of a 30,000 foot view. Now the Fed is continuing to say they're basically going to be in a holding pattern until we get more signs that inflation is going to be handled and or the job market is faltering. We haven't had signs, especially partially due to the research, but partially due to we had this great job number in March. The Feds again continue to be stuck in. They're kind of in the same spot they were a year ago. But
they're also sort of coming out and saying that like their definition of faltering has moved.
That's what that research has said. Yeah. Exactly. Whereas, a zero or negative growth 2, 3, 4 years ago would have been impetus for maybe either a cut or even an emergency cut. Now it's going to be like, well, we're not going to necessarily respond to that. So that's basically forced the Fed into a holding pattern. Some of the good news that's come out from the macroeconomic sphere of late is the American consumer just is the trusty fullback that whenever you need to hand it off to somebody, durable. I know we're not in football season, but they're continuing to be durable. You hand them the ball and they're going to give you, a good 5 or 6 yards, every time.
Well, it helps when they know they got a big tax refund check coming their way.
That's right. And so it's going to be interesting to see what happens after that. So even though they've been very, very durable, they're not invincible. And so, one of the themes I know we're going to talk about today a little bit later is going to be, how oil prices are going to impact both the producer and the consumer. So that's something we're watching over. But we saw growth in February, which is the most recent consumer data, show that consumer spending was up 3.7% of year-over-year basis. That's that's astounding. And that's just overall retail sales. And that was it wasn't even across all types of expenditures or all types of retail sales, but it was pretty widespread. I mean, we were seeing expenditures in general merchandise, actually
Mm-hmm.
in-store stuff. So it wasn't just all, e-sales, people buying it stuff. It's people actually going out to places, which is also important because when people go out to do things and they spend their money outside of their home, they might be more inclined to have knock-on expenditures, right? Like if I sit at
Yeah.
home and I order something from Amazon, right? Okay, maybe I'll see something that Amazon recommends to me. But if I go out to a store, I go down to Walmart or something and buy something. I might buy something from Walmart. But then while I'm out, my wife and I, if we're out, we might say, "Oh, well, let's go over here," like
Right.
an unplanned expenditure,
Absolutely.
which contributes more. So anyway, so that's part of
So you see that they're spending more, but how are they feeling about that?
This is one of the same things that we talked about last year,
Mm-hmm.
and we even talked about in January, Greg,
Yeah.
which is, do you trust how they tell you they feel, or do you trust how they're actually spending? And just last week, we got University of Michigan consumer sentiment numbers that came out to show
Mm-hmm.
that the American consumer is the most pessimistic they've ever been. So talk about mixed signals.
That sounds scary.
Well, I mean, it's the most emblematic of mixed signal environment that I think I could show.
Mm-hmm.
So they're continuing to spend, at least the February data. They don't line up perfectly, right? So it could be that, March, maybe it drops. But if we look at recent history as a comparison, do you trust how people feel, or do you trust what they do? Sometimes they line up. But last year we saw this with tariffs. Right. We saw a huge dive at this point last year in consumer sentiment. Consumers got really pessimistic about how they were feeling, and they were telling us they were feeling really bad, right? Consumers are feeling really bad. But the data suggests that they didn't spend any less, right?
Yeah.
And so we're again, this is going to be another stress test of that theory of, well, should we, how much of a predictor of expenditures is a consumer sentiment survey? Last year didn't bode well for believers of the consumer sentiment survey. Now I would kind of inclined to believe that maybe they aren't going to be pulling back spending as much as they're telling us in relation to how bad they feel. So like we don't want to ignore that, but we also don't want to totally just if you would ask me,
You don't want to be too worried.
Yeah,
Because it's not really bearing out.
if you ask me, how I feel about stuff, I could tell you I don't feel great, but doesn't necessarily always influence my behavior.
Yeah.
Sometimes
I might not feel great about my lawn care bill, but I still have to take care of my lawn.
Yeah. It's exactly that. If you, you're my manager, you're my boss, Greg. So I can tell you this right here in this is, I may leave a meeting at work and be like, I don't feel like that went too great, but it doesn't necessarily mean that I'm going to stop working, right? I'll find a way. Yeah, thank you. Yeah, I'll find a way around it. Okay, all right. How do we move on? So anyway, so that's that's kind of the 30,000-foot view of the macro economy. We are obviously going to be keeping an eye on inflation, and we did have inflation numbers that came out recently, and if you pay attention to the headline number, doesn't look great, but that was driven by energy prices. I mean, none of us are living under rocks, and we know that gas prices have gone up. But if you actually get rid of that and you look at core, which is inflation removing, volatile food and energy prices, it's been pretty stable. I mean, it's only gone up about 0.2%, month over month over the last 2, 3, 4 months. So it had been cooling. It had been cooling a little bit from the end of tariffs, and before that, we had a period of inflation cooling from the pandemic. Right? So something we're paying attention to. Something else, last thing I'll kind of say about the macroeconomic environment with relation to inflation is real income growth. So real income growth, or disposable income, growth in disposable income, which is, okay, how much more money are people making, and then how much more are things costing? And because of energy prices, we are at a point where there really is neither growth nor decline in real income. That income growth is basically being offset by inflation growth, which, given the recent spike in prices of energy, is actually not too
I mean,
crazy.
I'm sort of optimistic about that because if you believe that the energy price spike is going to be transitory in nature, in other words, once the situation in the Middle East is worked out one way or another, you know, it'll stabilize. Then that means people are going to see real wage increases.
Exactly. I mean, wages tend to be sticky
Yeah.
in that, you start to pay people more, it's really hard
Mm-hmm.
to like pay them less. And prices can be like that too, but energy prices, I think are much less sticky than wages, right? Than when
Commodity prices in general.
yeah, exactly, commodity prices in general. Um, so anyways, that's something that we're looking out for, and I think there's more of a likely that disposable income will kind of rebound and become positive again after after energy prices
Yeah, I mean, but the
normalize.
other elephant in the room, right, is like, what is it like? What's everyone's biggest expenditure? It's how much money they borrow to, pay for their house,
Yeah, yeah,
right? So, like, I mean,
and a lot of that's fixed for
where
people.
where goes energy prices is where inflation goes, which leads to what they can do with
Interest.
interest rates and everything in between. So, how does that play into this?
Yeah, I mean, we'll talk about that in a little bit.
Hmm.
Because the housing market unlocks a lot of stuff, and that's
Yeah.
something that has been relatively, I would say, stuck. But there hasn't been a lot of movement, and it's because folks have been waiting for mortgage rates to come back
Hmm.
down, and so inflation expectations directly or
Yeah.
indirectly also lead to
And if we
that.
can
So
get to a point where there's a nice refinancing wave, then
yeah,
people have even more free cash flow.
yeah, they can have more free cash flow, and they might also decide to take cash out of their house.
Yeah.
The housing market now. It's been a few months since I've looked, but the amount of equity that's built up in people's homes
Hmm.
hovers near historic highs.
Hmm.
But people aren't tapping into it because interest rates are high, and they're probably waiting to not only maybe buy or sell a house, but also tap that equity that they often might use to buy
Right.
durable goods, right?
Right.
Especially big
Redo
ticket
the
durable.
house.
Redo the house, but upgrade, all the appliances, or
Hmm.
upgrade their kitchen, or upgrade their laundry room, or,
Hmm.
or whatever. Um, so, uh, so yeah, I mean, as far as the macro data is concerned, the things that we, think matter most for durable goods,
Hmm.
energy prices is kind of the elephant in the room, and we'll, continue to talk about that and monitor it. Not just in today's podcast, but I'm sure the next time we meet, it's still going to be an evergreen theme.
So we're today living in a world of oil prices above $100 a barrel. Um, but we do believe here, at least at this table, that they'll ultimately fall back below that.
Yeah.
In the meantime, though, what can we expect to see in the durable goods market? How are they going to be impacted, and what can they do about it?
Households use energy for many different things, but primarily one of the things they use energy for is as a means to basically sell their labor. And that's a fancy way of saying like they use it to commute. But something else is that businesses use energy. We know businesses use energy. They
Hmm.
use it to make things. That's an obvious things. But they also use it to make investments, right? So, they use it to make use energy to make investments. They might. The common thing today is like data centers, right?
Yeah.
Big companies will invest in data centers, but we also use energy implicitly when we're using technology. I mean,
Hmm.
if we sit here and use AI for stuff that uses energy, if we're substituting AI, for
Yeah.
some things that we would pay people for, that also matters. But what's also could be an interesting thing to hear from your perspective as a CEO running a company.
Yeah.
How do you think? And I know we don't represent the typical company that's out there in the economy, but we don't represent an atypical. But like, how would you, as a CEO, think about rising energy costs
Yeah, I mean, I
and
think we're pretty
something?
lucky to be a data and technology company. So it's more minimal for us. But like you said, like we're using servers and data centers, and, as those input costs go up, they'll be passed along to us. So I think about it a little bit. But, primarily I think about what it means for our customers who are actually making physical goods.
Yeah,
Um, those goods need to be both manufactured and somehow shipped and make their way into someone's home.
Yep.
And so hopefully, the higher prices are going to be more transitory in nature. I think the other thing to think about, which is somewhat philosophical but still interesting,
I'm all about philosophy, Craig.
is that we're probably at our lowest demand here in the U.S. for oil that we've ever been at. Not that it's not important, and not that we don't demand a lot of it, and not that it doesn't affect others abroad, even in bigger ways. But here, right, like whatever way you think it's ebbing or flowing, we have installed a lot of alternative energy. The consumer has it for sure. We have cars and we have solar panels now in many houses, not all, but many, right? People work from home,
Yeah.
right? They don't even need it to commute.
Yeah.
So those are some big swings that we've seen. And then of course businesses too, or data centers like you mentioned before, right? There's a whole to do now about, people fearing that data centers are going to drive energy prices up. Well, no one's going to let that happen. So what is everyone talking about? They're talking about the data centers having their own energy resources
creating their
to
own
create,
energy,
right? Create
Yeah.
it themselves, right?
Yeah. I mean, that leads into, I think what we're going to talk about next in a very good way, which is direct and indirect effects of rising energy prices on both demand and supply of goods. I think what's important thing that you noted is, we're not 100% energy independent from the rest of the world, but the degree to which we are independent is, sort of the highest it's almost ever been in a modern age. I would say, a clear example of this, not totally related to durable goods, but just independence, is we essentially are pretty much fully independent when it comes to natural gas. So many of the issues that are happening in the Middle East now with shipments of natural gas getting through the Strait and getting to the rest of Europe and Asia, we're pretty much unaffected, right?
Yeah.
We have a pipeline, and we're pretty independent. But even if you go beyond that to something more relevant and tangent, which would be gas prices, we've seen gas prices increase, but they've gone up 20%. No one likes that. Right. But, we don't necessarily have a shortage of gasoline. I mean, no one's really rationing. Hopefully, knock on wood, that we don't get to that point. And then on the other side of things, on the consumer side, our reaction function, when I'm getting at, to use wonky terms from economics, our reaction function as a society to high energy prices may not be as high, or might not be as sensitive as it's been in the past. In other words, maybe there shouldn't be as much concern, or the flow through, the pig and the python might not be as big and as slow as it has in the past, because of the independence and because of the nature of work. You mentioned, commuting. You didn't immediately say, "Oh, I'm worried about, en masse as a society, or as our company, of people of higher gas prices." There's been a movement towards electric vehicles. People aren't working every day in the office. Some people aren't working in the office at all. They're working remotely. So that insulates the effect. And it would also mean that, would be a little bit more resilient to these fluctuations. I mean, not completely insulated, but certainly more resilient. But yeah, there's thinking back to the producer. Yeah, I mean, the direct stuff's very obvious, right? Like, you have transportation and shipping costs, right? You mentioned they have got to make things and they're going to send them out. You have warehousing and logistics, like the intermediaries of the folks that actually get
more
back
indirect things that you don't think of every day.
Yeah, there's certainly more indirect things. There's substitution effects with respect to imported goods. If we're more insulated to the rest of the world, domestically made stuff, independent of tariffs, if we're more insulated from an energy impact, that makes our goods a little bit more competitive.
Right. Well, we have lots of foreign brands that manufacture in the United States now.
Yeah. including some of our clients that we've noted.
And including great brands that are actually American brands that manufacture
Yeah.
here,
Yep.
right? So
Yep.
there's lots of choices still.
There absolutely is a lot more choices, and that makes overall a little bit more of a resilient type of economy, which would partially explain why the consumer's been a little bit more resilient maybe than otherwise folks were suggesting. So, but it, that said, it doesn't mean that we're fully insulated. So, one of the questions would be, yes, if energy prices are sustained, how much and when does that actually translate into either reduced demand from the consumer? So, household budgets, right? We do still,
Like, when are people going to trade down, right?
yeah,
Like, that's ultimately
yeah,
what it is,
yeah,
right? Like,
yeah,
we have so many options here. We're lucky,
yeah,
right?
yeah. Yeah, and I think one of the litmus tests of that is start looking at. I know most consumer spending has been driven by the middle to upper cohort, but start looking at consumption patterns of those lower income distribution. Right, so those folks, a gallon of gas is a gallon of gas, whether you make $500,000 a year or whether you make $30,000 a year. So those are going to be more price sensitive. Would be, and so something we want to look at is to see, if we start seeing major changes on that side, you can start to be confident.
It starts there and it moves its way along.
It moves its way up. So that's an important thing. But
I think we looked at this last year too, so we're about ready to do another analysis.
I think so. Yeah, I think we're going to get some more data here. So I think by the next time we talk, we'll probably have some breakdown of consumption by different income tiers. But what's also interesting is, when does that pass through? Like if you're a producer and you're faced with higher prices, higher input prices, let's just say you're having to, I don't know, either pay more to ship things or having to pay more to produce things, even if you're a little bit more resilient to energy prices. What's the thought process? And again, for listeners of the podcast or the first round, or folks that read things that we've written over the last year, it's not going to sound too different from our our writings last year on tariffs. And that was, well, okay, maybe it's going to depend on what your margins are. So, I mean,
Sure.
if you have relatively high margin, higher ticket items, are you necessarily going to want to, are you going to be able to absorb? Might you be able to better absorb higher input costs, or are you going to just pass the price along right away?
And that's the calculus that someone needs to take, right? Like, is it an opportunity to, take the hit and then, maintain or build new relationships?
If you've got, I mean, if your
It may depend, right? Like, it may depend on, not all categories of products are exactly the same here, right?
Yeah.
Part of it might be, how often you use the item,
Yeah.
right? How is the item used indoors or outdoors?
Yeah.
Right.
How durable is it?
Yeah.
Yeah.
How durable is it really? Right. Like, are you making a 4-year purchase, 3, 4, or 5-year purchase? You're making a 10 or 15-year purchase.
Yeah. And how sensitive are consumers of those goods going to be? For many high ticket durable goods, just say a fridge, sometimes a fridge is going to be, you're going to have to replace it because it just broke down and you need a fridge. Other times, maybe it's a little bit more discretionary. I'm going to decide to upgrade my kitchen and
but not every fridge also lasts the same amount of time too.
No, but if the margins on things like fridges are relatively high, a producer might be like, well, I'm not going to really mess around. I don't want to get, I can choose to take a little bit more of a hit in an attempt to maintain or even grow.
Well, especially
share.
if you think this is like a 3 or 4 month thing.
Yeah, exactly. That's the other thing. If you think it's like going to last forever,
Right.
then you might start thinking about, how do I plan for raising prices?
Right. And the flip side of that also is like, some of these brands all of the brands have spent a lot of money building their equity.
Yeah.
And so, like, do you want to mess with that over something that's maybe transitory for a quarter or two.
Yeah, and price increases in a way that are driven by something like, say, higher energy prices aren't necessarily that different from tariffs,
Hmm.
right? You don't expect like the price of oil goes, I don't know, say from $70 to $100 a barrel. Okay, it has an impact, but if that becomes the new stable point, it's not like price increases then have to persist forever.
No, it's stepwise.
It's stepwise. It's stepwise, and then unless the tariff continues to go up, or unless prices of oil continue to go up, it just then you don't
Goes away.
continue to get inflation like pressures upwards like
Hmm.
after that, right? Which is very different from like the sources of inflation that we saw during the pandemic, which was where we got shortages of things that are persistent, right?
Plus, like just from like a game theory perspective, right? Like if whoever moves first to raise their prices to maintain their margin, someone's going to try to take advantage of that and say like, all right, I'll forego that margin for a little bit. I'm going to try to steal those customers.
That's right. In economics, I mean, you have a degree in economics. You know this that we've one of the first things you learn is first mover advantage. But in this instance, there's first mover disadvantage if you go to raise your price. So if you don't have to, you might be like, all right, well, I'm going to wait and see before I make any rash decisions. Or if I can afford to do it, I might maybe try to get a little bit more competitive and ahead of the game. And that's certainly, I think, something that we're seeing. And this could be a good segue into our next point of what are we seeing with durable goods prices, and inflation from our own measures.
And we have a lot of pricing data. We measure it constantly. So,
Oh,
and not to be like the shameless CEO of OpenBrand here, but like, all of our customers are looking at this data right now, like having this exact conversation internally to decide what they're going to do with their prices.
Yeah. It shouldn't be shameless. I mean, one of the reasons why, I chose to come work here with you is because we have, probably the best database of pricing on the planet when it comes to consumer durable goods. So we see stuff. Like we see stuff. We see what's going on. The most recent OpenBrand CPI report, durable goods in March. But interesting tale, right? So we saw a big increase in energy prices in March, right? We saw the price of oil, depending on your measure, go from $60, $70 a barrel up to over 100, right? What we did not see, as measured by our own consumer price index of durable goods, was that translating into major increases in prices. We have not seen that yet. Now, that could be because of a number of different things. It could be because
time.
So the pig and the python takes a while for the python to digest that big pig. But also we have kind of a newish discount period in March now. Amazon has the Amazon Big Spring Sale. They've had that to some degree in prior years, but what was different about this year was a lot of their competitors followed suit. They got on the bandwagon of, we need a promotional period in between like President's Day and Memorial Day or Easter.
I mean, like consumers are now conditioned to never buy anything unless it's on sale.
Yeah, that's and as they should, right? As they should.
Yeah, I just hope that they're really getting a deal when it's on sale.
So that's an interesting question. So at a 30,000 foot view of prices, we haven't seen major increases. It could be because producers are not passing that on yet, like we discussed. We have now a huge promotional period, and then we're also getting some stimulus, right? So producers, retailers may know that, okay, I'm going to discount stuff to make it look like a discount, but I'm not really taking a ton off. Well, if you look across all the major retailers that participated, in some cases that was we saw very minimal increases of discounting activity amongst Amazon and Walmart. Amazon and Walmart still by far have the largest share of things that are discounted, but compared to times past, and by times past I mean look at the first 3 weeks of March. The last week of March was Amazon's big spring sale. The first 3 weeks was not. Kind of a control period. We used February also as a control period. We used last July as a control period, which was the Prime Day, Prime Big Deal Day, and then we used a year ago. And the big winner of all this, as far as like who really stepped up their game, wasn't Amazon. It wasn't Walmart. Best Buy a little bit. We saw Best Buy increase.
Yeah.
It was Target.
Interesting.
They almost tripled, not quite, almost tripled. They went from about 7% in February in the beginning of March up to over 20% of all of their products were on discount, target.com.
Wow.
So even though the share of all goods that they're selling on discount was not as high as Amazon or Walmart, which is up around like 40%, you really see an inflection point in their discounting activity. But something else, so that was interesting to see. We did release, as you know, the April 10th Nowcast actually comes out today, and
everyone's sitting on pins and needles.
Including me. I updated it over the weekend. Just wait for the thing to finish to run, and again, it wasn't, at least through April 10th, was not major signs yet. I mean, yes, we are seeing a little uptick. We did revise March down a bit, but it's again modest increase. Now, it doesn't mean that the longer the oil prices stay high, the more likely things are going to trickle down into the cost and price of things, independent of like oil, right? But so far, it's not limitless, right?
Well, it's also sort of related to the perception of how long the war in Iran will take, right? Like, how long will these prices stay
So
high?
on that note, how do you think this all plays out? I mean, what is your, not to put you on the spot. I mean, we've talked about this.
I think ultimately we all lack a lot I information. But I do think
the statement of the year,
and it's not the kind of information that I can readily provide to our customers. But what I would say is that I don't think that there's an appetite for a long, drawn out situation. So I think it'll resolve itself relatively quickly.
I agree. That's certainly, many of our forecast models are leaning more on that side. And above all, I mean, war is never a real popular thing.
Well, also, it's just always about leverage, right? And there just are limited leverage points for the other side. I mean, ultimately, if we've now blockaded, as of this morning, the Strait, they're not going to get any money from that now that it's blocked. And those that would have heretofore needed to use it are going to start to think about alternatives. Like, well, our alternatives are, we say, hey, come, send your ships to us. We've got oil for you. We'll sell it to you. But the other producers there who need the Strait will find alternative routes, whether they be new pipelines or land or what. It's not ideal. That takes time. But ultimately, they're going to start to look in other directions.
But in the meantime, as far as durable goods, it'll be interesting to see how manufacturers play into promotions, especially going into promotional periods in the spring and the summer. Are we going to see different trajectories of the depth and breadth of promotions? They're going to try to be competitive, and if they have the same view that we do, that look, this is something that maybe wraps up in 3, 4, 5 months. It's possible that we don't get as much translation into inflation. Again, very, very, very much akin to tariffs. Which we did see some pickup last year, but it wasn't catastrophic.
Well, the next big promotional period is going to be Memorial Day to July 4th, right? And so it'll be interesting to see how this plays out and leads up to that, and what the effects of this are on that.
Yeah, and there may be for high demand good, barbecues and outdoor stuff, things like that. It's you kind of I would say you don't have one shot a year, but you're limited window
Hmm.
to actually do that. So you may say, well, okay, I'm not going to adjust price this year. I'm going to try to keep market share, grow my market share. And if next year comes around and things haven't been resolved, then maybe then I'll consider raising prices.
Hmm.
So.
So you still expect people to go out to the garden center and pick up the plants and plant them for the season, and
I mean, for a lot of folks, it's a pastime,
right,
right? Regardless of what
right.
prices are. Yeah.
So Ralph, what are the big takeaways?
What are the big takeaways? What should executives be looking at? What should consumers be looking at? Um, Look, durable goods pricing is always in flux. There may continue to be some reasons why inflation may not get out of hand as much as some folks are expecting.
Hmm.
Um, some of that may have to do with the very fundamental nature of how we get our energy, where we actually make things, how people get to and from their place of employment,
Hmm.
and then also by retailer strategies. Unless your margins are so thin and your turnover is so quick that you can't absorb any price increases,
Hmm.
which I think is there's not that many goods that kind of lie on that, at least in the consumer durable space,
Hmm.
that you may get manufacturers and retailers just decide to, okay, take it. But watch, watch pricing, watch discounts if you're interested in where inflation is going to go, and watch energy prices, and pay attention to, where and how oil is actually getting to us,
Hmm.
and where 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 things are happening in the Middle East as far as the ability of ships to come in and out of the Strait of Hormuz. I mean that's in the short run that's a huge it's a huge thing.
Right, and the
And
timing is just going to matter a lot.
yeah, and folks over there also don't want um, oil to not move because many of the income of countries in the Middle East are based on that. So certainly pay attention to that. Um, and I think a final thought would be pay attention to the American consumer,
Hmm.
and that's something that we're a little delayed on because of the shutdown earlier in this year. We're a little delayed on information on the consumer coming out from the federal government,
Hmm.
anyways. But pay attention to not just how much they're consuming, and they've been very resilient, but also who's buying what. And fortunately, we've got a survey. Shameless self promotion. We have a survey that actually get at that a lot quicker than some government sources. And are we seeing big shifts by different income buckets and the different types of goods? So
Yeah, and it's a unique moment. It's a unique time. We have consumers getting money back from the government right now, which helps offset this a little
yeah,
bit.
yeah,
Right, we've got some big discounting periods that just happened, and some that are coming up, and we have less reliance on traditional energy than we've ever had before. Although we still have a lot.
yeah.
So.
I mean, the soft landing in this situation because of some of the stimulus right now would be maybe we get less of a bump from the stimulus because of what's happening in geopolitics
Hmm.
than we otherwise would, as opposed to if that wasn't happening at the same time, maybe there would be a pretty significant impact to things like GDP, right? I mean, we're already going to get probably a rebound from GDP from the opening of the government again,
Hmm.
but also we get a rebound from the stimulus, and if that cushions
Hmm.
the impact of what's happening abroad, but we get it wrapped up fairly quickly, maybe it's relatively unscathed on the economic side of things.
Hmm.
But
Well, it certainly helps to have a few more million people in the government working and spending money.
yes, it does. It does. Truth be told. Truth be told.
Well, this has been great, Ralph. Thanks for coming on again today, and we look forward to the state of durables Q3.
Looking forward to it.